Imagine it's December 3rd, 2001. You're Maria Elena Vasquez, a 52-year-old schoolteacher in Buenos Aires. You've spent 30 years building what you believed was a modest but secure retirement. Every month, without fail, you deposited a portion of your salary into your savings account at Banco de la Nación. You didn't invest in stocks. You didn't speculate on real estate. You trusted the system. Your life savings, $43,000, held in a dollarized account specifically because you remembered what inflation did to your parents, sits in the bank. You wake up that Monday morning, you make coffee, you turn on the television. The finance minister, Domingo Cavallo, is speaking. He announces something called the corralito, the little fence. Effective immediately, no Argentine can withdraw more than $250 per week from their bank account. Your $43,000, the product of 3 decades of discipline and sacrifice, is now behind a locked gate. The government explains this as a temporary measure, a necessary precaution. They use phrases like to protect the banking system and to prevent capital flight and in the national interest. You call the bank. The lines are jammed. You walk to the branch. There's already a crowd forming. Some people are crying. Others are screaming. One man is banging on the glass doors. A security guard tells everyone to go home. He says it will only be a few days. It won't be a few days. Within weeks, the government will forcibly convert your dollar-denominated account into pesos at an exchange rate of 1.4 to 1. Then the peso will collapse. By the time the corralito partially lifts, your $43,000 will have the purchasing power of roughly $12,000. You followed every rule. You saved instead of spent. You avoided risk. You trusted the explicit promise of your government and your banking system. And you lost 70% of your life's work in a single administrative decision. Here's what I need you to understand. Maria Elena's story is not unique. It is not even unusual. It is, in fact, the most common story in monetary history. It follows a pattern so consistent, so structurally predictable that once you see it, you'll recognize it everywhere. This isn't theory. It's documented history. The promise sounds different each time. The language changes, the institutions change, the currency changes, but the mechanism is identical, and the ending is always the same. Today, we're going to perform an autopsy on the economic promise. We're going to examine why it's made, how it functions, when it breaks, and who pays the cost. Because this pattern didn't start in Argentina. It didn't start in the 20th century. It has been repeating for as long as governments have issued money. And it is repeating right now. When governments announce emergency financial measures, capital controls, withdrawal limits, bank holidays, currency conversions, they frame them as crisis management. The narrative is always the same. External forces are threatening the system, speculators, foreign banks, market panic, irresponsible actors. The measures, we're told, are temporary. They exist to protect ordinary citizens. The alternative would be worse. This framing serves a purpose. It positions the government as the defender of the people against chaos. It suggests that trust in institutions should increase during the emergency, not decrease. It implies that compliance is the path to safety. In Argentina, in 2001, people initially believed this. Many thought the corralito would last weeks, maybe a month. The finance minister was a respected economist. The banking system had been stable for a decade. The peso had been pegged to the dollar since 1991. There was no reason to assume the worst. In Cyprus in 2013, when the government announced a bail-in that would confiscate a portion of all bank deposits over 100,000 euros, officials described it as a one-time levy, a necessary sacrifice to save the banking system. The European Central Bank and the International Monetary Fund both endorsed it. Surely institutions of that stature wouldn't support something unless it was both necessary and contained. In Greece in 2015, when the government imposed capital controls limiting ATM withdrawals to 60 euros per day, citizens were told this was a temporary measure during negotiations with European creditors. It would lift as soon as a deal was reached. The deal took months. The controls lasted in various forms for years. In each case, the public narrative focused on the immediate crisis, on the exceptional circumstances, on the temporary nature of the response. But this is surface-level analysis. It describes the event without explaining the system. Because what's actually happening beneath these emergency measures is not crisis management. It is the final stage of a much longer process, a process that began years, sometimes decades, before the crisis became visible. Every sovereign economic crisis follows a life cycle. It does not appear suddenly, it accumulates. The first stage is expansion. A government, for reasons that seemed justified at the time, war, recession, social investment, infrastructure, political survival, begins spending beyond its means. It borrows, it issues debt. The borrowing feels painless because interest rates are low, economic growth is positive, and international creditors are willing to lend. The second stage is normalization. The debt grows, but so does the economy, or at least so do the metrics that make the debt appear sustainable. Debt to GDP ratios rise, but they rise slowly. Officials point to other countries with higher ratios. They cite economic projections that assume future growth will outpace future obligations. Borrowing becomes not just acceptable, but expected. It becomes the foundation of fiscal policy. The third stage is constraint. At some point, different for every economy, but inevitable for all, the mathematics change. Growth slows. Interest payments consume an increasing share of the budget. Creditors become nervous. They demand higher interest rates to compensate for perceived risk. This makes the debt more expensive to service, which makes the fiscal position worse, which makes creditors more nervous. A feedback loop activates. The fourth stage is denial. Governments, facing a constraint they cannot solve through normal means, begin making promises. They promise that the currency is stable. They promise that deposits are safe. They promise that the situation is temporary. They promise that sacrifices will be shared. These promises serve a function. They prevent capital flight. They maintain confidence. They buy time. The fifth stage is the break. The promises become mathematically impossible to keep. The gap between obligations and resources becomes too large to hide. Something has to give. And what gives is always, always the promise. This is where emergency measures appear. The capital controls, the bank holidays, the forced conversions, the temporary confiscations. They're not crisis management. They're the mechanism by which the break is administered. They're the tool used to transfer the cost from those who created the problem to those who trusted the system. Think about what that means. The emergency measures aren't designed to protect citizens from the crisis. They're designed to prevent citizens from escaping the crisis. They lock people inside a burning building so the fire can consume their assets instead of spreading to the assets of those who got out earlier. Here is the mechanism explained as clearly as I can explain it. When a government accumulates debt beyond its capacity to repay through ordinary taxation and growth, it faces a trilemma. There are only three exits, only three. The first exit is default. The government admits it cannot pay its debts, negotiates with creditors to write down the obligations. This is politically humiliating. It damages the country's ability to borrow in the future. It often triggers immediate economic crisis. Governments almost never choose this voluntarily. The second exit is inflation. The government pays its debts in nominal terms, but debases the currency so that the real value of those debts shrinks. If you owe 1 billion units of currency and you can print as many units as you want, the debt is always technically payable. The catch is that the currency loses purchasing power. Savers, pensioners, and anyone holding cash or fixed income instruments watches their wealth evaporate. This is a default on the population, not on the creditors. The third exit is confiscation. The government directly takes assets from its citizens to cover the gap. This can happen through special taxes, forced bond purchases, deposit freezes, pension fund seizures, or currency conversions at artificial rates. It is the most visible betrayal, but often the fastest. Most crises involve a combination of all three. But the key insight is this. Once the constraint binds, once the debt mathematics become unsolvable through growth and ordinary revenue, one of these three things will happen. There is no fourth option. The role of the promise is to delay the recognition of this reality long enough for insiders to position themselves and for the mechanism of extraction to be built. Capital controls cannot be announced in advance. If the government says, next week we will limit withdrawals, everyone with resources will withdraw everything this week. The controls would be useless. Therefore, the promise of normalcy must be loudest precisely when the break is closest. This is why the pattern is so consistent. The reassurance and the betrayal are not contradictions. They are two phases of the same operation. In Argentina in 2001, President Fernando de la Rúa appeared on television on November 29th to declare that the banking system was absolutely stable and that deposits were safe. The corralito was announced 4 days later. In Cyprus in 2013, the finance minister denied any plans for a deposit confiscation, right up until the weekend it was announced. In Greece in 2015, Prime Minister Alexis Tsipras called a referendum on creditor terms, promising voters that a no vote would strengthen Greece's negotiating position and never result in the country leaving the euro. Within days of the referendum, capital controls were imposed anyway, and within weeks, Greece accepted terms harsher than those initially rejected. The promise is not a lie in the conventional sense. The officials making it may genuinely believe it at the moment they speak. But it is structurally untrue. The mathematics had already determined the outcome. The promise existed to manage the population's behavior until the moment of extraction. This mechanism is not modern. It did not begin with central banks or fiat currency. It is as old as state-issued money itself. In 301 AD, the Roman Emperor Diocletian issued the Edict on Maximum Prices. Rome had spent decades debasing its coinage, reducing the silver content of the denarius to fund military campaigns and imperial administration. By Diocletian's reign, the denarius had lost over 95% of its silver content compared to 2 centuries earlier. Prices had risen accordingly. Soldiers' wages, fixed in nominal terms, bought less and less. Diocletian's solution was to mandate maximum prices for over 1,000 goods and services. The edict carried the death penalty for violations. It was framed as a measure to protect ordinary Romans from greedy merchants. What was actually happening was that the state had destroyed the currency and was now criminalizing the population's natural response to that destruction. The edict failed. Goods disappeared from markets. Trade moved to the black market. Within years, the edict was effectively abandoned, but the pattern was established. In 1789, the revolutionary government of France needed to finance itself without the tax infrastructure of the old regime. It created a new currency called the assignat, backed, supposedly, by the value of confiscated church lands. The assignat was declared legal tender. It was promised to hold its value. It was described as temporary. By 1796, the assignat had lost 99% of its purchasing power. The government printed more and more to cover its expenses. Prices rose accordingly. The state responded by making it a crime to refuse assignats at face value. Citizens who demanded gold or silver in trade could be executed. In 1933, President Franklin Roosevelt signed Executive Order 6102, requiring all American citizens to surrender their gold coins, bullion, and certificates to the Federal Reserve. The exchange rate was set at $20.67 per ounce. Citizens were told this was necessary to stabilize the banking system during the Depression. 1 year later, the government revalued gold to $35 per ounce, a 40% increase. Anyone who had obeyed the order and surrendered their gold had effectively been confiscated from. Those who hid their gold gained. Those who trusted the government lost. In 1946, the Hungarian government, facing post-war hyperinflation, issued a new currency called the pengo to replace the old one. Inflation accelerated anyway. The pengo became worthless. In August 1946, the government introduced the forint, convertible at a rate of 400 octillion pengo to 1 forint. It remains the most extreme currency collapse in recorded history. People who held savings in pengo-denominated accounts at the start of 1946 had their wealth erased. Every promise of deposit security was void. In 1967, British Prime Minister Harold Wilson, facing a currency crisis caused by persistent trade deficits and speculative pressure on the pound, was forced to devalue sterling by 14%. 3 days before the devaluation, Wilson's government issued an official denial that any such action was planned. After the devaluation, Wilson appeared on television and said, "It does not mean that the pound here in Britain, in your pocket or purse or in your bank, has been devalued." This statement was technically accurate and substantively false. The pound was worth 14% less in terms of imported goods. Anyone holding sterling lost purchasing power immediately. Wilson's statement became infamous because it captured the essence of the promise. The words meant nothing. The math was already done. In every instance of the promise being broken, there is a distribution of outcomes. Someone loses, but that means someone, relatively speaking, wins. Understanding who benefits is essential to understanding why the mechanism persists. The first group that benefits is government itself. The breaking of the promise allows the state to close a fiscal gap that had become politically and mathematically impossible to close through ordinary means. Argentina's default and currency collapse erased dollar-denominated debts to its own citizens. Greece's capital controls prevented a bank run that would have collapsed the state's ability to function. The seizure of American gold in 1933 gave the Federal Reserve the reserves it needed to stabilize the banking system. The cost of government overreach is thus transferred backward in time, taken from citizens who trusted past promises rather than extracted from taxpayers who would resist present burdens. The second group that benefits is those with advanced knowledge or sophisticated access. In every crisis, there are actors who exit before the gate closes. In Argentina, wealthy families and corporations moved dollars offshore in the weeks before the corralito. In Greece, shipping magnates held their assets in foreign jurisdictions and faced no capital controls. In Cyprus, there is documented evidence that significant sums were transferred out of Laiki Bank, the institution most affected by the bail-in the days before the announcement. This is not necessarily a conspiracy. It is structural. People with access to better information, better legal structures, and better banking relationships can respond to early warning signs that ordinary depositors cannot see. The promise is designed for those who have no choice but to believe it. The third group that benefits is creditors with seniority. In sovereign debt restructurings, international bondholders are often treated more favorably than domestic savers. This is because governments that default on foreign creditors face exclusion from international capital markets. Governments that default on their own citizens face angry voters, but angry voters don't freeze your access to foreign borrowing. Argentina's 2001 crisis devastated local pension funds and savers, while international bondholders eventually recovered significant value through legal action and renegotiation. Cyprus's bail-in protected senior bondholders while confiscating from uninsured depositors. The pattern is consistent. Those closest to the system, with the most resources and the best positioning, pay the smallest share of the cost. Those who trusted most, who had the fewest alternatives, who followed the rules, they pay the price. Maria Elena Vasquez lost 70% of her savings, but she was not alone. In Argentina, the corralito and subsequent pacification destroyed the middle class. Estimates suggest that between $50 billion and $70 billion in savings were effectively confiscated through the forced currency conversion. Retirees who had saved for decades found their pensions worth a fraction of their previous value. Small business owners who held operating capital in banks were unable to access it. Suicide rates spiked. In Cyprus, the bail-in seized approximately $4.2 billion from depositors with balances over 100,000 euros. Many of these were not wealthy individuals, but small businesses, pension funds, and foreign workers who had accumulated savings over years. The Russian depositors who received the most media attention were a small fraction of those affected. In Weimar Germany, the hyperinflation of 1921 to 1923 did not harm everyone equally. Those who held debt benefited. Their obligations evaporated. Those who owned hard assets, factories, land, gold, saw their relative wealth increase. But the middle class, which held its savings in bank accounts, bonds, and insurance policies denominated in marks, was annihilated. A generation's savings became worthless. In Venezuela, the ongoing collapse of the bolivar has destroyed the purchasing power of anyone holding the domestic currency. Official inflation rates exceeded 1,000% in 2018. Those with access to dollars, either through connections or foreign income, have maintained their living standards. Those without, the majority of the population, have experienced poverty not seen in decades. The pattern is not that everyone suffers equally. The pattern is that the cost is allocated based on exposure to the promise. Those who believed it most, who built their lives around it, bear the greatest burden. There is a temptation, when examining these cases, to believe that better leadership could have prevented them, that if only the right decisions had been made, the promise could have been kept. This is a comforting belief, but it is not supported by the evidence. Once the constraint binds, once debt levels exceed a threshold beyond which growth and taxation cannot service the obligations, the outcome is determined. The only variables are timing and distribution. Argentina's crisis was baked in by the combination of a fixed exchange rate and fiscal indiscipline. The convertibility system, which pegged the peso to the dollar at 1-to-1, required either perpetual fiscal discipline or eventual collapse. When provincial governments continued to overspend and the federal government could not politically cut them off, the system had no flexibility left. Greece's crisis was baked in by the structure of the Eurozone itself. A monetary union without fiscal union means member states cannot devalue their way out of competitiveness problems and cannot run independent monetary policy. When Greece's debt reached 180% of GDP and its economy was contracting, there was no mechanism for adjustment except internal devaluation, crushing wages and prices, until the economy became competitive. This process takes years, causes mass unemployment, and is politically almost impossible to sustain. Cyprus's crisis was baked in by a banking sector that had grown to 7 times the country's GDP, concentrated in Greek government bonds that were about to be restructured. When Greece's bonds were written down, Cypriot banks became insolvent overnight. There was no amount of domestic taxation that could fill a hole of that size. The promises made before these crises, that deposits were safe, that currencies were stable, that the situation was temporary, were not lies in the sense of deliberate deception. They were impossible commitments, made by officials who may have genuinely believed them, but whose belief did not change the mathematics. Once you understand this, you understand why the pattern repeats. The promise is not a feature of bad government. It is a feature of the constraint itself. Because admitting the constraint before it binds would trigger the crisis early, and no government chooses that. I have not told you any of this to predict what will happen next. Predictions are a fool's game. The timing of constraint binding is unpredictable, influenced by confidence, external shocks, and political accidents that no model can capture. But the pattern is knowable, and the conditions for the pattern are observable. As of the most recent available data, the United States federal debt exceeds 120% of GDP. Interest payments on that debt now exceed spending on national defense. The Congressional Budget Office projects that, under current law, debt will continue rising indefinitely relative to GDP. Japan's debt exceeds 260% of GDP. The Bank of Japan owns more than half of all outstanding government bonds. The yen has lost significant value against the dollar over the past decade. China's combined government, corporate, and household debt exceeds 300% of GDP. Much of this debt finances real estate and infrastructure that generates returns insufficient to service the obligations. The Eurozone peripheral economies, Italy, Greece, Spain, Portugal, maintain debt levels that would be unsustainable without European central bank intervention. That intervention requires political consensus that may not hold indefinitely. I am not saying any of these systems will break tomorrow. I am saying they contain the same structural features that preceded every historical instance of the promise being broken. They carry the same mathematical constraints. They are governed by officials who make the same reassurances in the same language. When analysts describe these economies as stable, they are correct in the short term. The constraint is not binding today, but the constraint exists. And when it binds, the mechanism will activate. The question is not whether the mathematics apply to modern developed economies. The mathematics are universal. The question is whether modern governments have discovered an exit that their predecessors did not. History suggests they have not. Listen to the language used by central bankers, finance ministers, and treasury officials today, not to analyze their policies, but to recognize the pattern. The banking system is well capitalized. Deposit insurance protects savers. We have the tools to address any instability. Current debt levels are sustainable given growth projections. This is not 2008. These statements may be true in the immediate context, but they are the same category of statement that has preceded every breaking of the promise. They are reassurances designed to maintain confidence and prevent capital flight. They function the same way whether the officials speaking believe them or not. The structure of modern deposit insurance is particularly instructive. In the United States, the FDIC insures deposits up to $250,000 per depositor per institution. This insurance is backed by a fund that, as of recent data, holds roughly $128 billion. Total insured deposits in the U.S. banking system exceed $10 trillion. The FDIC fund represents approximately 1% of covered deposits. This does not mean the insurance is fake. In normal circumstances, when individual banks fail, the FDIC can resolve them using the fund. In systemic circumstances, when a significant fraction of the banking system is threatened simultaneously, the fund is inadequate and must be backstopped by the Treasury, which means the taxpayer, which means the currency. The promise of deposit insurance in a systemic crisis is ultimately a promise backed by the printing press, which means it is a promise that can technically be kept in nominal terms while being broken in real terms. This is not a criticism. It is a description of the mechanism. I want to return to Maria Elena Vasquez, standing outside her bank in Buenos Aires in December 2001. She did nothing wrong. She followed every instruction her society gave her. She saved. She trusted. She believed the promise. And when the constraint bound, she was inside the building. She could not escape. Her wealth was transferred to those who had positioned themselves before the break. She represents billions of people across history who have experienced the same mechanism. Ancient Romans watching their coins lose value. French revolutionaries watching the assignat collapse, Germans watching their marks become worthless, Greeks watching their euros locked behind capital controls. The faces change, the currencies change, the dates change, the pattern does not change. The promise is made because it must be made. Confidence is the operating system of monetary economies. Without it, the system stops functioning. Governments cannot tell the truth about the constraint because the truth would trigger the very crisis they hope to avoid. So the promise is repeated. Deposits are safe. The currency is stable. This is temporary. Trust the system. And for most of history, for most people, the promise holds. The constraint never binds in their lifetime. They never see the mechanism. But the mechanism is always present. It is embedded in the mathematics of debt. It is latent in every fiscal system. It waits. The question is never whether it will activate. The question is when and who will be inside when it does. This is historical and educational analysis. It is not financial or investment advice. The systems we've examined today, Argentina, Cyprus, Greece, Weimar, Rome, all had experts who believed they understood the situation. All had officials who promised stability. All had citizens who trusted those promises. Understanding the pattern does not guarantee escape, but it does allow recognition. And recognition is the first step toward positioning. This channel exists to study the autopsies before they repeat. If this lens was useful, subscribe. Most people never see the pattern until it's too late.